Look at this chart. The market is falling fast, panic is everywhere, and your RSI drops below 30. Your first thought might be, it's cheap, I should buy. But almost every trader who does this ends up trapped, losing money, or watching their account bleed. Today I show you why RSI can give false signals in a fast, scary market, how to spot warning signs, and how to protect yourself from getting stuck in a trade. This topic actually came from one of the followers who asked me to explain this. If you have a topic you want me to cover next, comment below. I'll make a video about it. Stay until the end. The skill I'm about to teach you can save your account and change the way you trade. Understanding a black swan, sudden crash. Let's start by looking at this chart. Notice how the price drops suddenly, forming long red candles. This is what we call a rapid market decline or a crash. You might have heard the term black swan in trading. A black swan is a very rare and unexpected event that shakes the market hard. It comes suddenly and most traders are not prepared. One famous example was in February 2020 when the COVID-19 panic hit the stock market. The S&P 500 dropped more than 10% in just a few days. Many traders, even professionals, were caught in positions, had to close at a loss, or watch their accounts bleed while trying to recover. Not every price drop is a crash. A crash has its own features. Lows continues to fall. Highs fail to reach previous peaks. Red candles are bigger than green ones and appear in a sequence. Selling is aggressive, often with low liquidity, meaning the market is dominated by sellers while buyers are not stepping in. In these situations, many traders look at the RSI indicator and enter trades because it signals oversold conditions. But relying on RSI alone is a mistake. Why? I will explain this in the next chapter. The problem with RSI. In fast market drops, many traders look at RSI and see it below 30. They think the market is oversold and the price is cheap, so they try to buy. But here's the problem. RSI only measures the speed and size of the recent price moves. It cannot tell why the market is falling, whether strong sellers are still in control or if people are just selling out of fear. During a sudden drop, RSI can fall below 30 very quickly. You might see a small bounce, RSI rises slightly, and it looks like the market is reversing. But this is often temporary. The main downtrend is still strong. If you buy now, you can get trapped, and the price may continue falling while RSI gives no warning. Many beginners fall into this trap. They buy just because RSI says buy, but the market keeps dropping. Their trade gets stuck and losses grow fast. So what's the solution? It's simple. Don't rely on RSI during a fast-moving crash. First, check if the market is truly in a crash, because not every drop is dangerous. If it's indeed a crash, skip RSI and wait for the market to calm down before considering any RSI signals. How to detect a crash? To determine whether a price drop is truly a crash, start by looking at the price structure. Ask yourself, are the lows continue to falling one after another? Are the highs to reach previous peaks? Are the red candles larger than green ones and appearing repeatedly in a sequence? In other words, your eyes need to be trained to read the speed and pressure of the market. But what if you are a beginner? How can you detect a crash without years of experience? For this problem, I discovered a simple solution after years of trading, the Trendline angle. Next, we will learn how to use it step by step in a way that even beginners can understand. Introducing Trendline angle. As discussed earlier, to determine if the market is in a crash, we should measure the trendline angle. Draw a trend line, align the recent highs in a downtrend, then check its slope. The steeper the angle, the faster the market is falling. In TradingView, the easiest and most accurate way to measure its angle is by using the info line tool, not the regular trend line tool. Here's how to do it. On the left side of your screen, see the drawing tools. Select the second option from the top, then click the small arrow next to it. Choose Info Line from the drop-down. Now draw your line connecting the main highs of downtrend. The Info Line tool will show you the angle of the line. One important thing, when you zoom in or zoom out, the angle can appear to change. To fix this, right-click anywhere on the chart, go to Settings, then under the Scales and Lines tab, check Active Lock Price to Bar Ratio. This keeps the angle accurate no matter the zoom level. Once you have your line and the angle is displayed, here's how to interpret it. 0 degrees means horizontal, no significant downtrend. From -15 to -30 degrees, the market is in a gentle downtrend. The price is falling slowly. From -30 to -45 degrees, the market is dropping fast, so be cautious. 45 degrees or steeper, that's a sudden crash. Don't buy. Remember, the bigger the negative number, the steeper the fall and the faster the market is dropping. By using this method, even a beginner can have a clear objective number showing how fast the market is moving instead of relying only on RSI signals that may be misleading during a crash. Combine trendline angle with RSI for confirmation. You can still use RSI as part of your analysis, but never rely on it alone, especially in a fast-moving downtrend. Every time you consider entering a buy trade during a falling market, check 3 things first. Is RSI low? A low RSI alone does not mean the market is ready to bounce. It only shows that price has dropped fast. Is the trend line angle steep? If the slope of the downtrend line is very steep, steeper than -45 degrees, it means the market is falling rapidly. Buying at this point is risky. Are there consecutive large red candles? Big red candles in a row indicate strong selling pressure. This shows that buyers are not yet stepping in. If all 3 conditions are true, don't enter a buy trade. Waiting is safer than jumping in too early. By combining RSI with the trendline angle and candle patterns, beginners can make smarter decisions, avoid panic losses, and prevent being trapped in a fast-moving downtrend. Think of it as a triple check system. RSI gives a signal, but the trend line angle and candle structure tell you if it's actually safe to act on that signal. Here's the key idea I want you to remember. The market is unpredictable and sudden crashes can happen anytime. No indicator, not even RSI, can predict panic. But you can control how you react. Most traders see the crash, panic, and react too late. You will spot the warning signs first. If this video gave you a fresh perspective, put it into practice. The more you practice, the more your eyes will naturally spot dangerous drops. For more practical strategies to read the market like a pro, check out my other videos and subscribe. And if there's a specific topic you want me to cover in the next video, leave a comment below. I promise the next video will be about it. Thanks for watching and I see you in the next video.